So what is moving average? So moving average is an indicator that seems to follow the price. So if you see the price heading up over time, right, your moving average will be pointing up higher. If you see the price heading down lower, you can expect your moving average to be pointing down lower as well. And why is that? And that's because of the math behind it. So let me explain. So it's nothing too complicated. It's going to be pretty simple, I promise you. So the math behind moving average, or rather the idea behind it, is that moving average calculates the average price over X number of period. So let's say if you're looking at a daily time frame and you have a 5-period moving average, what this does is that it calculates the average price over the last 5 days, since it's a 5-period moving average. So let me show you how this works. So let's say you're looking at the chart and you have bars like this. This is the first candle, this is the second candle, this is the third candle, this is the fourth, and let's say this is the fifth, right? 5 candles on your chart. And let's say the closing price of these 5 bars is $1, $2, $3, $4, and then $5. So this, right, the first candle means the price closed at $1. Second candle means the price closed at $2. This one closed at $3, this candle closed at $4, and this candle closed at $5. So let's say you overlay this chart with the 5-period moving average, right? What will the value of your moving average be? Well, it's going to be pretty simple, right? What you're going to do is to add the total, right, of this closing price. So 1 plus 2 plus 3 plus 4 plus 5, and you divide by 5, since we are calculating the average price over X number of period. Our X number of period in this case is a 5-period moving average. So you take 1 plus 2 plus 3 plus 4 plus 5, divide by 5. And if you do that, okay, your answer will be along the lines of divide by 5 equals to $3. How do I know that? You can just pull out your calculator and you'll see that this average of this 5 candle, the average price is 3. So let's say we add one dot over here, right, at this price point. I'll explain what this dot means shortly. So now let's say a new candle has formed, right? Price is closed higher on this 6th candle over here. And let's say it closed at $6. Now, what is the new 5-period moving average value? So what you're going to do is you will now, okay, take the most recent prices, right, over the last 5 candles. So 1, 2, 3, 4, 5. So you take 2 plus 3 plus 4 plus 5 plus 6. You divide by 5 and you get the value of 4. Now you might be wondering, hey Rayner, what about this first candle number 1? Well, we'll ignore it because we are calculating the 5-period moving average. We are just looking at the 5 most recent candles. So in this case, right, we have 6 candles over here. We will ignore this one, the oldest one. So this is the 5 most recent candles from here all the way to here. So again, we just calculate the average of this total value here, 2 plus 3 plus 4 plus 5 plus 6, divide by 5, and you'll get $4. And what you'll do is you add in, let's say you draw another dot over here. So if the price keeps, going up higher, what you can do is you realize that your dots gets higher and you connect the dots, it will appear as a moving average on your chart. And that's how it works. Okay, so hopefully you got some aha moment down here. Okay, so this is just some simple calculation which I've, shared with you earlier. So now, the key thing is this, right? How do you actually use moving average to define the market structure? So let's find out. So for an uptrend, what you can do is when the price is above the 200-period moving average, you can say that the market is in an uptrend. So let me give you an example. So let me go through the stuff here first. In a downtrend, right, is when the price is below the 200-period moving average. So some of you might be wondering, hey Rayner, why 200-period moving average? Well, there's really nothing magical about this, but when we use 200, right, it will take into consideration, right, 200 bars on your chart. So it will give you like a long-term guideline to whether this market is heading higher or lower. So this is kind of a way to help you define the long-term trend. And finally, the market is in a range, right, when the price chops up and down the 200-period moving average. So let me just show you. So for example, Euro against the USD, I'll add in the moving average here. So if you're wondering how to do it, right, just go to indicators, you look for moving average. Right, you can see over here, just click on this and the line will appear. So in this case, I already have it on my chart. And if you look at Euro against the US dollar, you can see that this market is in an uptrend. The price is above the 200-period moving average. Now, if you look at the dollar against the South African rand, you can say that this market is in a downtrend because the price, which is here, is now below the 200-period moving average. And if you look at this one over here, pound against the Canadian dollar, you can see that this market is in a range because the price, right, you can see it's chopping up and down the moving average. Okay, so we can conclude that this market is in a range. And that's how you can use moving average to help you define your market structure. Okay, so let's do a quick recap. Number 1, Market structure helps you to define the current market condition so you know whether to be buying, selling, or staying out of the markets. So for example, if you see a market in an uptrend, what do you want to be doing? Well, you want to look for buying opportunities. That's the path of least resistance. If you see a market in a downtrend, what should you be doing? You should be looking for selling opportunities because the market is heading down lower over time and there's a good chance it will continue to head down lower. And finally, if you see the market is in a range, then you can look to, buy low and sell high, buy near the lows of the range and sell near the highs of the range. And I'll explain how you can do all that in the later section. But for now, just understand, what is market structure and how it can, help you alert you right to what you should be doing at any one point in time. So market structure consists of uptrend, downtrend, and range. You already know this. And finally, you can use a candlestick chart or moving average to help you define market structure. So now at this point, right, you have learned market structure, but it's just the first step because a market could be in an uptrend, but it doesn't mean you want to blindly hit the buy button because the market could be getting ready to make a pullback or even a complete reversal. And the last thing you want to do is to buy high and sell low. So this is why it pays, right, to be watching, right, for your areas of value on the chart so you can better time your entries. And this is what we'll cover next.